Starbucks is another one of those quality stocks that has been beaten down a lot year to date. The stock is down over 18% on the year. Over the last 5 years, it's been an absolute disaster. It's down over 13%, sitting at $76 per share. And the question is Starbucks a generational buying opportunity at this price? Is this the time to be buying Starbucks? Is this the time for us to be greedy when others are fearful? Or maybe Starbucks is still overpriced despite the stock going down so much. It happened with many stocks, and it could also be happening with Starbucks. But this is what I'm going to determine in this video. I'm going to give you my fair value and tell you if I believe Starbucks is a good buying opportunity or not. For the last earnings report, again, it was also a disaster. 68 cents versus 79 cents for EPS. Very, very bad. They also missed on revenues. I'm sure you've seen the viral interview with Jim Cramer and the CEO. I mean, the CEO couldn't even answer questions. He had no plans about the future. It was really bad. Even the previous CEO is, kind of judging the new CEO or the current CEO of Starbucks from having a lot of mismanagement in the company. But a lot of things are going wrong for the stock. It's still a quality company, of course, still an amazing brand. A lot of people love Starbucks, but it's been struggling recently. But Starbucks is not the only one. McDonald's is also struggling. You have a lot of different, even Darden restaurants, Olive Gardens, and Longhorn Steakhouse, and so many brands that they own, affordable brands. They're also struggling. So it's not only Starbucks. We have a weaker economy in general. If we look at the comp sales, 3% decline in the United States, 11% decline in China. China also has a weak economy, especially in terms of real estate. Car prices are depreciating like crazy. So again, it's not just Starbucks' fault. It's partially Starbucks' problem, but it's also a problem of the economy in general, and things are slowing down. And some people, they just cannot afford the $10 coffees they used to afford. Maybe they make it at home. Maybe they do something else. They buy a cheaper one. And this is just what's been happening. And this is completely normal. You're not going to have an expansion forever. And this is just a rough patch for Starbucks at this moment. In terms of guidance was also very, very bad. In terms of revenues, low single digits. This is a company used to grow 10, 12% revenues, like 15, 16, sometimes 20% earnings per share. I think those times are long gone. In terms of GAAP EPS and non-GAAP, they have flat to low single digits in terms of earnings per share. It's really, really bad. And again, this is what's happening with Starbucks. But there's some positives with the company. If you look at revenues, yes, total revenues did decline a little bit. They declined 1.8%. But what I really liked is they're trying to focus a little bit more on cost. So if you look at product and distribution costs, they declined 5.5%. And this allows them to somewhat maintain operating expenses to being flat, which is, it's good. It's a pretty good improvement. They're facing some pressure a little bit on labor. Labor is increased 5.5%. It will continue to increase as unionization is a big problem for Starbucks. It's also for many different companies, but especially for Starbucks, if this continues to happen, it's going to face a lot of pressure on labor in the short term. Maybe in the long term, AI or maybe something they can automate a lot of that stuff. Maybe 20 years from now, I don't know how quick they could do that. But in the short term, they're facing a lot of headwinds in terms of commodity prices and also in terms of unionization, labor, which is ultimately going to increase general administrative expense and employee expenses in general. It's not good at all, but they did do very well on maintaining product and distribution costs. So that's very good from the company. In terms of the balance sheet, it's not the best, but it's not too bad. They have around $3 billion in cash and cash equivalents and you could say short-term investments. Not much on short-term debt, like 42 million. Long-term debts, they have $15 billion. But I did say they have $3 billion of cash. And I'm not really worried about the debt of Starbucks. They could refinance it. They could push it off in the future. So sometimes I don't focus on the balance sheet of companies that have a good credit rating and they have some kind of resilient free cash flow. Like I talked about Pepsi. A lot of you told me, why don't you talk about the balance sheet? I'm like, Pepsi is not going to zero, guys. Like Pepsi could just gonna refinance. This Pepsi is like a telecom. Telecoms, they have high debts. They could always refinance, push it off later. Maybe interest expense is a problem, yes. But again, that's why I don't focus on it too much with Pepsi, because I don't want to make the video 20 minutes long for me trying to go in every single, thing in the balance sheet to waste your time and put more ads in the video so I could make more money. I'm trying to save you time, make the videos as short as possible so you don't have to spend 20 minutes watching an analysis that could be done in 10 minutes. But for Starbucks, again, the balance sheet is not a problem, but I just wanted to go over it just in case you guys were wondering why I don't analyze balance sheets. But for return on capital, 33% 20% return on capital, very high returns on capital for the company. This is a company that has a good track record. I mean, before 2021, the company has been growing amazingly well in terms of earnings per share, from 24 cents up to $3.24. It's also a good dividend grower. A lot of dividend investors love Starbucks, and it's currently yielding a 3% dividend, which I personally believe the dividend is safe. But now it's at 3.24 in terms of earnings per share. And since 2021, you had a lot of demand that was pulled forward. And since then, the company has really struggled to grow meaningfully. They did grow a little bit and they declined 2022. Then they grew a little bit again. But again, it's still struggling. It's not like a straight line like it used to before. And this is due to the company maturing, but it's also due to a lot of pumped up demand from 2021. 2022 was slower. And it's going to take some time for momentum to pick up again, for Starbucks to start growing, consistently. Maybe not as quick as they used to, but somewhat of consistent, predictable earnings per share growth. Now, if we look at where Starbucks is priced at, it's priced at 20 and a half times earnings. 20 and a half times earnings is one of the lowest Starbucks has traded at. So I have the data from 2009, late 2009. 20 times earnings. The lowest it has traded at was 16 times earnings. 16 times was, I believe, in 2010, 2011. And the COVID lows, it traded at around 20 times, and it's now currently sitting at 20.4 times. So if you look at this chart alone, you could see that this has been historically a good time to be actually accumulating Starbucks shares. And we can determine if this is the case or not by looking at my valuation model. This is where we could have a better look in the numbers and determine a fair value. But for Starbucks guidance, as we looked in the guidance, they have mid-single digits for revenue, it's low single digits, which is 1 to 2%. So I put in 2%. The analysts, they have 8.5% after that. I think this is extremely, extremely fair. I wouldn't bet on anything above it. Maybe they can grow 10% again. But this is, again, a very risky bet. And you guys have to understand it. Anytime the company goes from growing to no growth, it's a risky bet to bet on the next year having 8.5%. Look at Nike. Nike has still been a recovery play for almost 3 years. It was supposed to grow revenues again last year, didn't grow. This year it's not going to grow. And 2025 is not even going to grow based on their guidance. Maybe they're going to grow 1 to 2%. So this is a 3 years of no growth when people were betting on the company growing again next year after not growing the prior year. So this is a very risky bet. And even Estee Lauder has the same problem. So if Starbucks can pull off from 2% to 8.5%, that's going to be an amazing achievement. So betting on anything above that is too speculative. So that's why I have 8.5%. A net income margin is 11%. I kept it at 11%. P is 20 times earnings. I'm betting on a multiple expansion to 25 times earnings, which is high, which is, again, optimistic. But I'm trying to illustrate a point I'm going to tell you very soon. But even counting a multiple expansion from 20 to 24 times, counting a shareholder yield of 4%, which is a 3% dividend and a 1% buyback. The company buys back a little bit of stock, but around 1.5% of the market cap. Nothing crazy. With all that stuff, in total, I got 84% on the upside, or 14.4% CAGR. Now, you guys know, for me, I try to look for doubles. The average return of the S&P is like 7 or 8%, let's say 7%. I want at least 15% if I'm trying to buy Starbucks. But even with those optimistic numbers, if I want to get a double on Starbucks or 15%, I would have to buy the stock at $71, which is exactly where the stock was trading at the 52-week lows. It was $71. It also has been a good technical level to be buying Starbucks. It did bounce around $70, $69, $71. So for me, $71 is a good buying opportunity on Starbucks. It's still not even cheap for the name, but it's a pretty good buying opportunity at 71. Now, I'm not saying Starbucks is not a buy right now. If you're a very long-term investor or you're a dividend investor and you want to dollar cost average down, it's not bad. But if you're more like me, you're patient, you like to wait for the right price, you don't like to overpay for stocks, I think 71 is ideal on Starbucks. And if I'm comparing Starbucks to other opportunities like McDonald's, which has also been selling off, they're both trading at the same multiple. Now, yes, historically, Starbucks has been growing quicker than McDonald's. But if I look at net income margins, Starbucks net income margins are around 11%. McDonald's has a franchise business model with net income margins of 33%, triple Starbucks net income margins for the same exact multiple. Now, if Starbucks grows around 15-20% earnings per share again, then it's going to be extremely cheap at this price, much cheaper than McDonald's. But if you don't want to take this speculative bet, I would personally rather buy McDonald's at this price if I was forced to buy something. But if I wasn't forced and I was just waiting for the right price, I would wait for $71 on Starbucks, or maybe sell the $70 put if you're eager to own Starbucks, which I'm personally not. And again, this is just my honest opinion on the stock. It's not financial advice, just my opinion. Thank you again for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.